Imagine waking up to headlines screaming, "Bitcoin breaks $200,000, investors' wildest dreams realized." Now, what if I told you that some of the world's most battle-hardened Bitcoin holders are quietly stacking up billions of dollars worth of BTC, convinced that this scenario isn't just possible, but likely and closer than you might think? While panic and euphoria swirl around the crypto markets, this stealth accumulation by long-term Bitcoin believers might be the most important market signal of all. But as the stakes rise, so do the risks, and there's much more at play than just simple supply and demand. So, what do these so-called long-term holders see that most of us don't? Why are Wall Street giants jumping in, and could their bullish bets backfire? Today, we're diving deep into the heart of the Bitcoin bull case, revealing the hidden game that could make or break crypto fortunes in the next year. Let's rewind for a moment. Every 4 years, a seismic event shakes the Bitcoin ecosystem, the halving. It's a technical tweak, buried in the code, that slashes new Bitcoin creation in half. Overnight, the rewards for miners get twice as hard to earn, and with it, the supply of fresh new coins evaporates. This forced scarcity has a wild history of propelling prices to stratospheric heights, followed by gut-wrenching corrections. If you zoom out, Bitcoin's chart looks less like a roller coaster and more like a staircase, each halving marking the start of a breathtaking new climb. But this isn't just about algorithms and math. It's about human nature, money flows, and the relentless march of institutions into what was once the Wild West of finance. In previous cycles, retail investors, ordinary people swept up in FOMO, were the main buyers and sellers. But in the last 2 years, everything has changed. Wall Street is here, and it's not just dipping toes in the water, it's wading in with steel-toed boots and massive checkbooks. Case in point, BlackRock's IBET ETF now controls over 330,000 BTC as of late May 2025, a 15% jump since March. Fidelity's FBTC isn't far behind, holding 200,000 BTC, a 12% spike. Together, these two traditional giants now own more Bitcoin than most entire countries. Japanese firm Metaplanet, meanwhile, has been quietly scooping up coins, amassing over $11 million worth for its corporate treasury. Then there's MicroStrategy, the corporate diamond hands, sitting on a mountain of over 214,000 BTC, bought for an average price just over $35,000. Today, that stash is worth more than $24 billion. These are not weekend gamblers. These are deep pockets with long-time horizons and a taste for asymmetric bets. Now meet the most fascinating players in this saga, the Bitcoin long-term holders, or LTH for short. Think of them as the old guard, the survivors of every crash, the ones who don't sell through panic or hype. On-chain data shows that these investors have been in full accumulation mode, adding a mind-boggling 300,000 BTC, worth nearly $33 billion in just the last 3 weeks. Their spending activity, the rate at which they transfer or sell coins, is at an 8-month low. Translation? They're not cashing out, they're doubling down. When you look at the blockchain, the digital ledger that powers Bitcoin, you can spot these patterns. Glassnode, a leading analytics firm, revealed that long-term holders' supply jumped from 13.7 million to 14.3 million BTC in just 2 months this spring and is now past 15.8 million. Exchange reserves, the amount of Bitcoin just sitting on trading platforms, available for sale, are plunging. Fewer coins are up for grabs, and yet demand is holding steady or even rising. One expert, Axel Adler Jr., points out, LTH spending is at its lowest level in 8 months, signaling strong holder confidence, which could lead to decreased supply and increased prices. Why is this so important? Because in every previous cycle, when long-term holders started hoarding coins and refusing to sell, it triggered a classic supply squeeze. Think of it as a game of musical chairs. As more people want in but fewer coins are available, prices rocket upward. This dynamic is playing out right now, and not just among Bitcoin diehards. In recent weeks, the 30-day average of new, unique Bitcoin addresses, the digital equivalent of new bank accounts, crossed above its 365-day average. This surge suggests a fresh wave of investors is entering the network, potentially adding to demand just as supply tightens. But let's not kid ourselves. There's a storm of complexity brewing under the surface. Wall Street's ETF juggernauts bring billions in fresh capital and newfound legitimacy to Bitcoin, yet they're also stoking fears about centralization. When a handful of massive funds control a huge slice of the supply, can Bitcoin still claim to be decentralized, or is the era of people's money quietly ending? Antony Trenchev from Nexo weighs in. A target of $150,000 is still very much on the cards for Bitcoin by the end of 2025, driven by continued institutional interest and ETF inflows. It's not just about price predictions. Behind every surge are powerful macro forces. The global M2 money supply, the total amount of cash, deposits, and near money in the system, hit a low in 2022, right when Bitcoin bottomed out near $15,000. Since then, central banks have reopened the money spigots. Inflation stubbornly hovers above targets in the U.S., with the stock market and crypto both reacting to even tiny shifts in economic data. This April, a mere 0.3% rise in U.S. consumer prices was enough to nudge the dollar lower and, in lockstep, send Bitcoin higher. Amid all this, regulation looms large. The U.S. Senate is gearing up to pass the first federal stablecoin law, promising more clarity and consumer protection. For Bitcoin, which lives and dies by investor trust, this is a big deal. The U.S. regulatory environment is much friendlier than in the past, bolstering Bitcoin's prospects and attracting more institutional capital, says Paul Howard of Wincent. And as Caroline Bowler from BTC Markets puts it, today's demand is driven by institutional-grade infrastructure and stronger regulatory clarity, shifting investor sentiment toward institutional-style allocations. Still, optimism is never universal. For every bullish voice, there are skeptics crying foul. Dr. Kirill Kretov from CoinPanel delivers a stark warning. The current rally might be a trap, engineered by large players to liquidate weak hands, highlighting the risk of a sharp dip. Could it all be smoke and mirrors? Just another carefully orchestrated pump before the rug is pulled? Let's talk numbers. Options. Markets are seeing enormous bets. For June 2025 expiry, call options at the $300,000 strike price represent over $620 million in notional value. The $200,000 strike boasts $420 million in open interest. These are high-stakes wagers that Bitcoin's price could not just double, but triple from current levels. Are these sophisticated investors hedging or dreaming big? Either way, it's a barometer of the feverish sentiment gripping the market. Beyond the technicals, there's the psychological, perhaps the most unpredictable force of all. Bitcoin's every move is magnified by emotion. FOMO when prices climb, panic and despair when they tumble. This feedback loop is supercharged now that institutional money has entered the game, creating even bigger swings. Matt Crosby from Bitcoin Magazine Pro explains, Bitcoin's current upward momentum is primarily driven by spot-driven buying, suggesting a more sustainable rally than those driven by leverage. Here's where it gets really interesting. Historically, Bitcoin tends to smash through its old price peaks within 24 to 26 months of hitting a cycle bottom. That window? It's now. We're at month 24. The last time this pattern played out, Bitcoin shattered expectations. Could history repeat itself, or will a new set of challenges derail the ascent? Yet for all the investor confidence, danger still lurks. A sudden regulatory crackdown, a global financial shock, or a black swan event, like a major crypto exchange hack, could upend everything. And some worry that if ETFs keep gobbling up Bitcoin, market power could concentrate dangerously in a handful of corporate hands, eroding the very decentralization that made Bitcoin revolutionary in the first place. As we stand on the brink of what could be a defining year for Bitcoin, the market is split. The bullish narrative, fueled by shrinking supply, giant institutional bets, and a perfect storm of macroeconomics, makes new all-time highs feel inevitable. But the shadow of volatility and uncertainty looms large. Will long-term holders' conviction be rewarded with generational wealth, or is the market unwittingly marching straight into a sophisticated bull trap? In the next segment, we'll uncover the battle lines drawn by whales and institutions, decode the risks of centralization, and ask, if Bitcoin really smashes $200,000, who wins and who loses? And what could trigger an epic reversal just when confidence is at its peak? So, with long-term holders gripping their coins tighter than ever, Wall Street giants buying up Bitcoin like never before, and regulations slowly turning in crypto's favor, the stage is set for a showdown. But what happens next? Let's peer into the foggy, exhilarating future of Bitcoin and see what scenarios could unfold, and what it all really means for you. First, imagine this. The powerful hands holding hundreds of billions in Bitcoin refuse to sell. Large institutions, emboldened by new regulations and unstoppable ETF inflows, pour capital into the market. Bitcoin's supply is squeezed tighter and tighter. The price soars, slicing through $120,000, $150,000, then $200,000, a figure that not long ago seemed like pure science fiction. In this world, FOMO returns with a vengeance. Retail investors stampede back in, headlines scream about new all-time highs, and Bitcoin's story as a digital gold becomes mainstream financial wisdom. The momentum snowballs. Analyst Matt Crosby puts it bluntly, Bitcoin's current upward momentum is primarily driven by spot-driven buying, suggesting a more sustainable rally than those driven by leverage. If this scenario plays out, we could see Bitcoin hit $220,000, maybe even $250,000 by year-end. It brings with it not just wealth for early holders, but a profound shift in how the world views digital assets. Bitcoin, once a niche curiosity, becomes an unquestioned pillar of the global financial system, a generational moment. But let's not get blinded by the dream. There's another potential future, lurking quietly beneath the bullish hysteria. What if demand stutters? What if the macro backdrop darkens, maybe inflation spikes unexpectedly, or global liquidity dries up, or a geopolitical shock hits the markets? Bitcoin, ever volatile, could tumble. Prices could correct sharply, maybe plunging back to $80,000, wiping out the weak hands and forcing a long, grinding consolidation. It wouldn't be the first time. Remember, even in Bitcoin's most legendary bull runs, brutal corrections of 40% or more were not uncommon. James Van Straten from CoinDesk warns, Bitcoin has entered a strong accumulation phase across all wallet cohorts for the first time since January, indicating broad-based buying, but outflows can just as quickly become panicked selling if major risk events pop up. In this timeline, Bitcoin would chop sideways, frustrating both bulls and bears, until a new wave of conviction, or a shock to the system, finally breaks the stalemate. And then, there's a third path, institutionalization of crypto. Bitcoin becomes too big to ignore for regulators worldwide. New laws, like the stablecoin bill poised to pass in the U.S. Senate by August, bring mainstream legitimacy. Wall Street titans, pension funds, and even governments allocate massive sums. Bitcoin gains some price stability as the ecosystem matures. But this stability comes at a cost. Centralization. Power and liquidity are increasingly concentrated in a few ETFs and custodians. Retail investors and small holders find themselves living in a Bitcoin world run by the same big players who dominate traditional finance. Dr. Kirill Kretov of CoinPanel sounds the alarm. The current rally might be a trap engineered by large players to liquidate weak hands, highlighting the risk of a sharp dip driven by coordinated moves. In this world, Bitcoin's upside may be capped, not the wild $400,000 moonshots, but more modest targets in the $150,000 to $180,000 range. Still impressive, but the renegade spirit of Bitcoin faces a new test. There is, of course, a final scenario few want to talk about, what the old-timers call the black swan, a catastrophic hack, a sudden regulatory crackdown, or an unexpected fraud event that shakes the entire system. While the likelihood is low, history reminds us, never say never in crypto. So with all these possibilities, what should a savvy viewer actually do? How do you make sense of this wild, high-stakes chessboard? Here's what you need to know. First, recognize that the epic accumulation by long-term holders, the massive ETF flows, and the entry of corporate giants like BlackRock, Fidelity, and even Japanese conglomerates like Metaplanet, these are not ordinary buy signals. They represent tectonic shifts in capital and conviction. These players aren't betting on $10,000 moves. They're positioning for the next era of digital finance. Second, understand that Bitcoin's 4-year cycle, driven by halvings that slash new supply, remains intact, and we are now entering the historical window when explosive price gains have most often occurred. But history is not destiny. Rallies attract new money and new risks. Third, always expect volatility. As Antony Trenchev of Nexo says, a target of $150,000 is still very much on the cards for Bitcoin by the end of 2025, driven by continued institutional interest and ETF inflows. But he adds, the road there may be paved with breathtaking drops and wild swings. So, what can you do as an investor, trader, or simply someone at the edge of this digital frontier? 1. Take the long view. Long-term holders are the backbone of Bitcoin's resilience. They buy when fear is high, hold when greed is rampant, and ignore the noise. If you believe in the fundamentals, the finite supply, the growing adoption, and the digital gold narrative, patience may be your most powerful weapon. 2. Diversify your exposure. Institutions with billions at stake don't bet everything on a single price level or outcome. Neither should you. Consider dollar-cost averaging, buying small amounts over time to average out volatility and avoid the pitfalls of chasing parabolic moves or panic selling and drawdowns. 3. Stay informed, critically. The crypto sphere is rife with hype, misinformation, and manipulation. Use on-chain analytics, study ETF flows, and track regulatory developments. Listen to credible voices, but never follow them blindly. 4. Prepare for wild swings. If seeing your portfolio drop 30% to 40% in a matter of weeks would keep you up at night, size your exposure accordingly. As Ryan Lee from BitGet Research predicts, the path to $180,000 is real, but every phase in this market is an emotional roller coaster. 5. Never underestimate the risk of new kinds of centralization. If ETFs and institutions become too powerful, Bitcoin's original ethos, decentralized peer-to-peer value transfer, could be compromised. Watch which hands actually hold the coins, not just the ticker price. 6. Don't fall for the myth of guaranteed riches. There are no sure things in crypto. Every bull market is punctuated by sudden, gut-wrenching corrections, crashes, and sometimes miraculous recoveries. And finally, always do your own research. In a world where trillion-dollar decisions are made by algorithms and boardrooms, your own conviction is your best guide. So, let's return to the question at the heart of our journey. Will this wave of institutional and long-term holder confidence power Bitcoin to historic highs, or is a hidden risk, or even manipulation, lurking, ready to yank the rug at the last moment? Here's what the data, the experts, and the history tell us. Bitcoin's fundamentals have never looked stronger. Long-term holders are accumulating at one of the fastest rates on record. Exchange balances are at multi-year lows. ETFs, especially BlackRock's IBT and Fidelity's FBTC, now hold a jaw-dropping combined 530,000 BTC, and big money is not shying away, but surging in. The 4-year cycle, the macro backdrop of surging global liquidity, and a regulatory climate that is turning friendlier by the month, these are the ingredients for a historic rally. But, and it's a crucial but, the sheer size of institutional involvement brings new forms of risk. The possibility of manipulation, coordinated sell-offs, sudden liquidity shocks, or traps for retail investors cannot be ignored. As Dr. Kirill Kretov warned, the current rally might be a trap. Don't get caught off guard. So the answer? Both forces are at play. The machinery is in place for Bitcoin to break records, perhaps to levels few dare to imagine. But the ghosts of volatility, manipulation, and black swan events will always stalk this market. Your best defense? Wisdom, patience, and preparation. If you can ride the waves, keep your head clear in the storm, and resist being swayed by the wild emotions of the crowd, you put yourself in a position not just to survive, but to thrive as the new era of digital assets unfolds. And before we close, here's a secret most overlook. While the headlines follow the ETF flows and the billionaire buyers, the real revolution is in the shrinking supply. Every day, more Bitcoin disappears into cold storage wallets, never to be sold, creating a silent pressure cooker that, if demand simply holds steady, could send prices far higher than almost anyone expects. Now, I want to hear from you. Which scenario do you think is most likely? Are you bullish, preparing for a correction, or wary of institutional games? Drop your thoughts in the comments below and let's debate together. If you found this deep dive valuable, don't forget to subscribe, give us a like, and share with a friend who needs to hear what's really driving the Bitcoin market. And remember, in crypto, the greatest